This week in economics on the 28th of November 2015. Numbers man here, and let me get my mic adjusted here a bit so we can, as they say, roll on here. We are live today via the Spreaker franchise, and later will be archived on iHeart and the other outlets and Blog Talk, etc. We always appear live because the recordings obviously are live, and they are normally done minutes before the program appears. But today we're actually live here, and it's not pre-scheduled, but nonetheless you will get it. The holiday season rolls on, and we'll be talking about holiday shopping, the effects of holiday shopping on the American economy, and we'll look at in Europe and other places as we move along here. We'll start out with the setup piece here from Reuters, and I'll just read just a little bit of it here. America's annual Black Friday shopping extravaganza was short on fireworks this year as U.S. retailers discounted on electronics, clothing, and other holiday gifts failed to draw big crowds to stores and shopping malls. That's the brick and mortar part of the scenario. Less traffic there. Retailers have taken a sense of urgency out of the consumers by, of course, we talked about this, I believe, last week, spreading their promotions throughout the year, and what we're seeing is a result of that. That's from Jeff Simpson. He's director of retail practice at Deloitte. Traffic in stores was light on Friday, while Thursday missed his expectation. This is, again, from Deloitte. As much as 20% of holiday shopping is expected to be done over the Thanksgiving weekend, as the analysts say. But 4 days are not considered a strong indicator for the entire season. A slow start last year led to deeper promotions and a shopping rush, and consumers are holding out for that. In our closing, we always exalt the consumer to keep their eye on the prize, and evidently this year they did indeed keep it there. SunTrust Robinson Humphrey analysts, were more blunt, calling Thursday a bust. Members of our team who went to the malls first had no problem finding parking, and that's always a very bad sign for a mall. And other things going on there. The Macy's at Water Tower Place Mall in rainy Chicago saw thin crowds early morning. Later morning, more than 2,000 protesters clogged the Magnificent Mile shopping corridor. That's in Chicago. So basically, Chicago, that was full of protesters, and very little else were out there. And some of the major retailers here, the Target organization, 0.4%. J.C. Penney was down 0.7%. Macy's and Best Buy lost about 1%. Walmart dropped 0.6%, while Amazon was down 0.3%. And that sort of tells the story right there. The broad retail index was down 0.15% in abbreviated trading. Black Friday discounts included $700 off 60-inch Samsungs at Best Buy, 20% off $75 purchases at Target, and Kindles for $49, roughly $50 at Amazon. The National Federation is expecting holiday sales to rise 3.7, but they've been over-optimistic in the past. Slower than last year's of 4.1. Well, it will indeed be slower, and that has been a characteristic of the entire year. Let me go and we'll dive a little bit more deeply in this statistical situation here as soon as we get the right screen going here. And we're going to need to pass once more through this. This is sort of the short of doing it live, because if we're not doing it live, we can move in a little bit different direction. But we'll move here from Bloomberg here. Brick and mortar locations suffer is the headline here. About 1.73 trillion was spent online Thanksgiving Day. That's a 25% increase from last year. That's according to Adobe Systems. They've gotten evidently into the act, the people that make the PDFs. On Black Friday, about 822 million was spent by 11 a.m., 15% more than in 14. But these are Adobe's figures. They would be taken with a bit of optimism. And in this particular piece, this Jeff Simpson at Deloitte Consulting also is here across the board. Much less traffic was anticipated. So different stories are told here. Traffic forecast, 135.8 million Americans are expected to shop in stores. Now this is from the National Retail Federation. And Simon Siegel, an analyst at Normuller, saw decent crowds. This is in New Jersey, but expects many shoppers to have already made purchases online. The online scenario is in here. And we get also from IBM Commerce, more people in this game, incidentally, providing analytics. Online sales for Black Friday rose 21.5% from a year ago, with smartphones accounting for 44.7% of all online traffic. Smartphone shoppers spent an average of $121.06 per order, up 4.3% from last year. Online ship here. Retailers, the Walmarts, Targets, etc. of the world are providing free shopping returns on holiday orders. I was in a Target earlier, not for holiday shopping, but we bought a watch band of all things. It didn't work out, took it back, and it took them less than a minute to refund my purchase to the charge card. Nonetheless, Monday falling, dubbed Cyber Monday. I guess they're looking forward to that. Amazon sales rose at, at 28.8. We'll get to that in a minute. That's according to Channel Advisors, and we'll dive into Channel Advisors here. And the Target people even had command centers. I don't know if they had any control in that, but it was 1,800 locations inside the command centers. Workers glued to computer monitors, wall-mounted screens, could view lines outside the store. So they were, I suppose you'd say, spying on the consumers. Target said in a statement it had strong turnout on Thanksgiving, whereas other retailers, the outdoor retailer REI of Seattle, were closed. They had better things to do. And gaming consoles, TVs, that's the movies were among the top sellers. The company also said it sold an Apple iPod every second throughout the day. I doubt that very seriously. Back to Simpson of Deloitte, saw less lines out there. And let me just get this Channel Advisors blog here. We were looking at it earlier today, and it has here, it's a dashboard, the Cyber 5 results, and now we have 2 of the 5 days are completed. 40% is completed, and the totals here, 43.4% on Thanksgiving Day, so I won, and 20.3% there on Black Friday. And we break this down to Amazon, 28.9% on Thanksgiving Day, 20% on 0.8 on Black Friday. And eBay is 7% on Thanksgiving and 1.5% on Black Friday. And CSE 16.4% and 6%. And GS 35.9 and 40%. Here is their breakdowns. Computer traffic 30% on Thanksgiving, 39% on Black Friday. Tablet traffic, this is sort of broken down here a bit, 12% and 12%. Smartphone traffic, and this is what came out in the IBM Commerce analytic, 52% and 49% on Black Friday. Thanksgiving, and total mobile traffic, 64% on Thanksgiving and 61% there. Computer orders, 42% on Thanksgiving, 60% on Black Friday. Total orders, 21% and 12% there. Smartphone orders, 37% on Thanksgiving and 28%. So you can see where this is basically going here. And let's see, mobile orders, they total it up at 58 and 40. 40% being on a Black Friday. Black Friday is not what it used to be. And so we'll leave it at that with the consumers. And that's where they were. Now we'll be looking at Cyber Monday. I would assume a lot of the predictions, this was incidentally posted at 10 a.m. This morning by Steve Wingo. Maybe it's Wingo. Anyway, nonetheless, this was from the the Channel Advisors blog here, and we'll look back at them. Maybe we'll do a little special report. But from the Bureau of Economic Analysis, this is the National Income and Product Accounts, Gross Domestic Product, Q3. The second estimate here in corporate profits, Q3. This is 2015. Preliminary estimate. So we'll go right through these. Real gross domestic product, value of goods and services. You've heard that one before. Adjusted for changes, increased at an annual rate of 2.1% in the second estimate by the Bureau of Economic Analysis. In Q2, real GMP was increased 3.9%. GMP estimate released today is more complete source than were available in the advanced estimate last month. In the advanced estimate, the increase in real GMP was 1.5%, with the second estimate for Q3, the decrease in private inventory investment was smaller than previously estimated. This usually happens all the time. It's a little bit fluid this time of the year. The real GMP in third quarter primarily reflects positive contributions from personal consumption expenditure, that is PCE, non-residential fixed investment, state and local government spending, residential fixed investment exports that were partially offset by negative contributions from private inventory investment. Imports, which are subtracted in the calculation of GDP, increased. The deceleration in real GMP in Q3 primarily reflects a downturn in private inventory investment, a deceleration in exports, in non-residential fixed investment, in state and local government spending, and in residential fixed investments. Let me dive down here a bit. Real gross domestic purchases, as by U.S. residents, increased 2.2% in Q3 and compared with a 3.6% in Q2. The price index for gross domestic purchases, which measures prices paid by U.S. residents, increased 1.3% in Q3 compared with 1.5% in Q2, excluding food and energy. The price index for gross domestic product increased increased 1.3% compared with 1.2%, a little better there. Current dollar GMP, the market value of goods and services produced by the nation's economy, less the value of goods and services used up by production, increased 3.4%. Our 151 billion, that's in Q3, to a level of 18 trillion 64.7 billion. In the second quarter, current dollar increased, 6.1%, or 264.4 billion. There are some revisions here. Real GMP, this is the advanced estimate was at 1.5, and now we have 2.1. Current dollar was at 2.1. That was in the advance, and the second estimate 3.4. And we'll move on here to second quarter of 2005. Real GDI was revised up 1.5 percentage points from 0.7% to 2.2, reflecting an upward revision to private wages and salaries based on newly established second quarter tabulations from the Bureau. And I think, did we get this? Real GDI at 3.1, that's in the second estimate, and advanced GDP and GDI at 2.6 there. So, and the gross domestic purchase price index at 1.3 didn't change. Corporate profits, profits for current production, corporate profits with inventory valuation adjustment. We've talked about that before. The IVA, capital consumption adjustment, decreased 22.7 billion in Q3 in contrast to an increase of 70.4 billion in the second quarter. Profits of domestic financial corporations decreased 8.5 billion in Q3 in contrast to an increase of 37.6 billion in the second quarter. Profits of domestic non-financial corporations increased 15.8 billion compared with an increase of 24.3 billion in the second quarter. The rest of the world component of profits decreased 30 billion in contrast to an increase of 11 billion in the second quarter. This measurement is calculated as the difference between receipts from the rest of the world and payments to the rest of the world. In the third quarter, receipts decreased 7.2 billion and payments increased 22.7 billion. Taxes on corporation income increased 2.3 billion in Q3 compared with an increase of 31.3 billion in Q2. Profits after tax, that is the IVA and CCAD, decreased 25 billion in contrast to an increase in the second quarter of 39.2 billion. Dividends increased 27.1 billion in the third quarter compared with an increase of 1.2 billion in the second quarter. Undistributed profits decreased 52.2 billion in contrast to an increase of 38 billion in the second quarter. Net cash flow, IVA, the internal funds available to corporations for investments, decreased 0.9 billion in contrast to an increase of 48.1 billion in the second quarter. The IVA and CCADJ are adjustments that convert inventory withdrawals and depreciation of fixed assets reported on a tax return, historic cost basis, to current cost economic measurements used in national income and product accounts. The IVA increased to 35.3 billion in Q3 in contrast to 78.7 billion in the second quarter. The CCAD decreased 1.4 billion in contrast to 7.7 billion. Gross value added of non-financial domestic corporations. The real gross value added of a non-financial corporation increased in the third quarter. Unit profits from current production, profits per unit of real value added were unchanged. And And finally here, the nation and international, anyway, this is the end of that. The end of the report, I should say. And now we'll go to the BBC, the other part of our scenario here. And we'll get that up very, very quickly. We'll get more data in next week as to how the consumers are acting, but I would not really add as much value to it perhaps as we have had in the past, because it appears that we'll have more of a prolonged season as we used to in the past history in terms of what is called holiday shopping and euphemistically in the American context as the quote-unquote Christmas shopping. And the proverbial after Christmas sale, we'll be looking with a little bit of curiosity what is, in other words, what is left over. Very quickly here, the Dutch will appeal the Starbucks tax ruling. Dutch finance minister said it will fight a ruling ordering it to recover as much as 30 million euros. That is 21.2 million pounds in tax from Starbucks. These little cozy tax arrangements are being looked at very, very sharply here. Let me just check one thing here. We had some more very deep figures here. What happens sometimes is they get away, and we'll just look. We'll look them up once again. Not a big deal there. With German shoppers, toy makers, well, we'll get to German shoppers here. This is the other side of the coin in the European area. Confidence drops amidst economic fears. This is the German shoppers here. And German shoppers in Germany have dipped, according to a survey here, and worries over the larger economy in Europe. So this is sort of coming here. Concerns about the labor market led the way, according to a survey of 2,000 shoppers, with 69% of those surveys expecting an increase in unemployment. That will do it every time, and it was conducted before the attacks in Paris on Friday the 13th. In contrast to general sentiment, optimism was making a big purchase improvements, with the sub-index of willingness to buy climbing by 3 points to 48.9%. Let's see. Christmas sales, as customers might be tempted to shop online if they're concerned. This is the public safety thing. But let's now go to the consultancy here, CFK, and they have a consumer index, and this is issued on the 27th. There, the findings of a consumer climate study for Germany. Consumer sentiment in Germany has weakened once again this month, while the consumer climate has fallen significantly for the fourth time in a row. Its decline is significantly less than the previous months, falling a value of 9.4 points in November. Overall indicators forecasting 9.3 points for December, while the willingness to buy rose modestly in November. Both economic income expectations have suffered slight loss. Of German consumer confidence is continuing to weigh, and the fear here, consumers fear an economic slump, and that normally happens in economies right after the holidays. The downward side in economic expectation has been ongoing in November of this year. However, the decrease of 2.4 points witnessed this month is significantly lower than in previous 2 months, when losses of more than 9 and 10 points respectively were recorded. At 5.3 points, the indicator has consolidated its position in the negative value range. That's a negative 5.3, remaining under its long-term average of 0. One explanation of this is that consumers are expecting an increase in unemployment figures over the next few months. That would be in Q1 of 2016. Just under 40% of German citizens stated in November they believe unemployment would rise in the future, while 8% of respondents estimated it would fall. When asked about specific reasons for expected declines in the labor market, the majority of respondents were of the same opinion, with 69% of those assuming that unemployment figures would worsen in the next few months, attributing this to the refugee crisis. It's interesting here, they are more aware of the refugee crisis in Europe than in say, North America. For example, a similar survey conducted in October, 70% of those anticipated growing job figures. So you can see how things change on the wind. Seasonal adjusted effects, such as weather report. They're having, incidentally, a climate conference, a big grand conference in Paris, which has started, has a state there, etc. We'll be covering some of that on Boston Red, our sister forecast here at WBRN. Network here is we do political, economic, and we'll look at some technology here, but nonetheless, 3%, the Volkswagen income expectations remain extremely strong despite moderate losses in November. The income expectation indicator also experienced a modest decline, falling to 44.4 points despite a drop of 3.3 level remaining particularly high in comparison to the economic expectation indicator. This implies that consumers predict unemployment to rise. They still do not believe that they themselves will be affected. This is the old individual effect as to more national type of macro economic situation as to micro. Anyway, we won't get into much of that. But despite falling economies, increased income expectation recorded in November, the willingness to buy indicator increased this month. After 5 very modest drops in succession, the indicator has risen by 3 points to a total of 48.9 there. And from the German Federal Statistics Office, let's see, we have to go back. Extremely high levels provide evidence that the propensity to consumers is still very pronounced despite economic uncertainty. This is also proven by example of the particular positive developments of retail sales, and which include data from the German Federal Statistics Office rose by 2.7% in the first 9 months of the year. And falling a value of 9.4 in November, this is a consumer climate is still declined. The overall indicator is forecasting 9.3 for December 2015. Future consumer sentiments will depend on factors such as response of consumers to terrorist attacks in Paris. Since the survey was concluded the same day as the attacks, any possible impact could not be taken. And basically the survey here is based upon, as we said, 2,000 consumers. That's a pretty good survey, actually, if it were a poll. Is predicting a rise in, this is GFK, in private consumption of 1.5% for 2015. Again, this does not overly concern retail sales, but rather consumer spending. Last year, GFK also forecasts that private spending would increase 1.5, and according to figures from the Federal Statistic Office, it grew, this is in 2014, at 1.2%. Not too bad, actually. A little bit here, but again, this is one of the situations out here. And GFK is a trusted source a relevant market and consumer information that enables its clients to make smart decisions. More than 13,000 market experts combine their passion with GfK's long-standing data. In other words, they have big data here, and we'll move on with the rest of this report back to the BBC. Spend a little time on Germany here, but that is sort of the mix. In China, the market fell in as we go into our market. This is China's Shanghai Composite, dropped more than 5%. And there's an investigation of the nation's largest brokerage, CITIC, C-I-T-I-C. And negative statement here, sentiment weighing ahead of the new batch of initial public offerings. This is in the Chinese market. And Hang Seng, that is in Hong Kong, couldn't escape it. It was down 1.9%. The index fell 3% over the weekend as Hang Seng in Hong Kong. The Nikkei also was affected. Index closed down 0.3%. We'll get to that in just a minute here. Data released Friday, this is in Japan, showed the country's core consumer price index, CPI, recorded its third straight month of falls, down 1.10% there. Household spending in the country fell 2.4% during the period. And on a bright note, a job indicator, the country's jobless rate, this is Japan, may fall in the near future. Taking the labor market first, the unemployment rate fell to 3.4 to a 20-year from 3.4 to a 20-year low of 3.1, which suggests that the jobless rate may drop below 3% in the coming months. There, however, today's other data was rather disappointing. Core household spending slipped to 0.4% on month in October, falling at 1 point, and they've had a problem there with deflation at 1.8 month on month in December. In South Korea, the KOPI share index closed down 0.08% there. In Australia, ended their day 0.2% lower there, and the Sydney mining operation there, BHP, down 0.9%. So this is some information out of Australia. We'll go ahead and do the numbers now from the various markets around the world. Probably be Friday data more so than else, but we will see very quickly here. Friday, unless otherwise noted, the FTSE was down 6.49. FTSE all share. In Amsterdam, they were down 0.07. In Frankfurt, they were down 27.001 on Friday. In Paris, they were down 15.88. In Brussels, 0.08. They were in the positive range there. In Madrid, they were also down 21.60 in the negative. In Zurich, 34.71. In Moscow, they were down on Friday 32.60. In Johannesburg, 294.82 in the negative there. In Bombay, 142.57 on Friday. In Karachi, they were down 119.36 1-0. Lahore, they were also down 26.74. In Colombo, they were down 1.96 in the negative there. In Tehran on Wednesday, 13.70 in positive range. In Sydney, as we reported before, they were down 8.30. The Nikkei was also down 60.47, and Hang Seng was down 420.62 in Shanghai. They were also down on Friday 199.25. In New York on Friday, which would have been a short day for them, they were down 14.90. The Nasdaq, however, was in the positive at 11.38, and the Merc out in the Midwest city of Chicago, as the marches marched by, was 1.24 on Friday. In San Pablo, they were down on Friday 1,272.72, and in Mexico they were also down 126.54. And let me just jump to the top here. The BBC Global 30, it was at 14.39 in the positive range there. And on to commodities. And we'll see where we are on this holiday weekend, at least here. Brent crude futures were down 59 cents at $44.87. The spot was down the Brent crude futures was down 59 cents. The spot was down 47 cents at $45.07. West Texas crude was down 75 cents at $41.74. T-Bone Pickens is still jumping for joy. He remembers $15 a barrel oil, but that was at a time that $15 it was in the 70s, is about equal to where it is now. We'll figure that one out. Gold on the Forex here was down $5.85 at 1,064 and 1,064 and 65 cents. Get that right in a minute here. Dubai didn't report in today, and we'll skip down here to the Unex Live Futures. Cocoa was up $10. Robusta coffee was up $13. Sugar was down 5 cents. I don't know who's in the white sugar futures. And the Bloomberg Commodity Index was down $1.17. Our 1.4% down there, and it rests at 81.10. That is the Bloomberg Commodity Index, one of the things we have added here to our summation. Thus, we have got most of it, I guess you'll say. Pardon our English here. And we'll jump back here just a second here. Wait a minute here, just a minute. Take a big, quick look at the technology business here. Not much going on here at all. Business of technology tends to be, as they say, very uncertain. But nonetheless, this is a weekend, a holiday weekend, at least in North America. In Canada, they've already had Thanksgiving Day. And now we go into a Cyber Monday to take a look at where Cyber Monday will stand. I haven't looked at any of the predictions. That, of course, is online. And we'll see. The big Black Friday was also online. So you've seen a mixture of things. One of the trends that we did notice, and the more to mobile and smartphones being a mobile device, so very well. And I think part of that is that many, especially in the Android world, they moved to Marshmallow. We'll talk about that in Open Source Report. And some of the phones are coming out there. They're getting more powerful. a little bit better secured. More options are being added to them, so people are upgrading. But where does that stand in the smartphone world? Be interesting to add the other large, of course, Apple, iOS, their part of it. The Microsoft product line doesn't play as well there, and of course also tablets. So we have many, many things out there. Gadgetry, how will gadgetry play? The various boycotts by the environmental friendly firm, REI, the Justice or Else boycott called Black Friday and Thanksgiving and on through the holiday season by the leader of the Nation of Islam, Louis Farrakhan, who also is in Chicago. And it was a very effective march they had. Hundreds of thousands of people were there. It'll be interesting to see the statistics there. Consumer boycotts are very interesting indeed. So things are changing, at least on the anecdotal level here, and we'll get better statistics next week. And also, well, no, the Fed won't quite meet by that time, but that is coming up, and it'll be interesting to see how the market responds. And these governments move, especially in Europe, are moving more to accommodation or quantitative easing. The Fed's balance sheet is expanding. Last week we talked about Ralph Nader's letter to the chair of Janet Yellen and savers of America. Savers are being hurt, but one of the things you'll see is if they'll go up, say, 25 basis points. Actually, on interest rates rise to 2 to 4%, about 4%. Savers will start to get a little bit of accommodation at 4%, 4 to 6%. That will take a long time. So basically, that is flat. The Fed has a limited mobility as far as that particular situation is going. Let me just get to something very quickly here by the former chair of the Fed, Ben Bernanke. I don't think we had an opportunity to get to his little presentation here. He's writing at the Brookings Institute. Why are interest rates so low? And we'll just talk a little bit about this. Interest rates around the world, both short-term and long-term, are exceptionally low these days. The U.S. government can borrow for 10 years at a rate of 1.9%. And for 30 years at 2.5%. Rates in other industrial countries are even lower. For example, yields on 10-year government bonds, and this is very important here, is around 0.2% in Germany, 0.3% in Japan, and 1.6% in the United Kingdom. In Switzerland, the 10-year yield is currently slightly negative. And we talked a little about negative bond rates here, but again, the interest rate paid by businesses and households are relatively higher, primarily because of credit risk. In other words, governments don't go bankrupt. The lower interest rates are not short-term aberrations, but a part of a long-term trend, as a figure below shows. You can't see it. We'll post it on our show notes, at least a link to it. Relatively low in the 60s, rose to a peak above 15%. That was in 1981. Those were the glory days for savers. I can remember when people were rolling CDs over at 18, 19%. And have been declining ever since. That pattern is partly explained by the rise and fall of inflation, shown in the figure here. All else, capital equity investors demand higher yields when inflation is high, compared to compensation for the declining purchase power of the dollar, with which they expect to be repaid. But yields on inflation-protected bonds are very low today. The rest of the inflation-adjusted return lending to the U.S. government for 5 years is currently at minus 0.1%. So why are interest rates so low? Well, they remain low. What are the implications of it? If you ask the person in the street why interest rates are so low, he or she will likely answer the Fed is keeping them low. That is true only in a very narrow sense. The Fed does, of course, set benchmark normal short-term interest rates. The Fed's policies are also the primary determinant of inflation and inflation expectation over the long term. And inflation trends affect interest rates, as the figure above. Well, we can't do it anyway. But what matters most for the economy is the real or inflation-adjusted interest rate. The market in normal interest rates minus the inflation rate. The real inflation rate is the most relevant for capital investment decisions. For example, the Fed's ability to affect real rates of return, especially long-term rates, is transitory and limited, except in the short run. Real interest rates are determined by a wide range of economic factors, including prospects for economic growth, and not by the Fed. To understand this it helps to introduce the concept of equilibrium real interest rates, sometimes called the Wexelian interest rate, after the late 19th century and early 20th century Swedish economist, Carl Wicksell. Equilibrium interest rate is a real interest rate consistent with full employment of labor and capital resources, perhaps after some period of adjustment. Many factors affect the equilibrium rate, which can and does change over time. In a rapidly growing dynamic economy, we'd expect the equilibrium interest rate to be high, all else equal, reflecting the high prospective return on capital investments. In a slowing economy, our recessionary economy, the equilibrium real rate is likely to be low, since investors' investment opportunities are limited and relatively profitable. Government spending and taxation policies also affect this equilibrium real rate. Large deficits will tend to increase equilibrium rate against all else equal, because government borrowing diverts savings away from private investment. And I won't go into all this article here, but sometimes for brevity, a similar confused criticism often heard is that the Fed is sometimes distorting financial markets, and this is where we want to, as they say, stay here. Investment decisions by keeping interest rates artificially low. Contrary to what sometimes seems to be alleged, the Fed cannot somehow withdraw and leave interest rates to be determined by the markets. The Fed's actions determines the money supply and thus short-term interest rates. It has no choice but to set short-term rates somewhere. So where should they be? The best strategy for the Fed I can think of is to set rates at a level consistent with the healthy operation of the economy over the medium term. That is today's low equilibrium rate. This is absolutely nothing artificial about it, and of course it's legitimate to argue about where the equilibrium rate actually is at a given time, a debate that has Fed policymakers engaged in at their every meeting. But that doesn't seem to be the source of the criticism. And finally, Dr. Bernanke says, the state of the economy, not the Fed, is the ultimate determinant of the sustainability level of real return. This helps explain why real interest rates are low throughout the industrialized world, not just the U.S. And he gave examples of that in Switzerland and in Japan, etc. What features of the economic landscape are the ultimate source of today's low interest rates? I'll tackle that in a later post. So, since Chairman Bernanke will attack it in a later post, we will fall back upon him and his Brookings blog, which he's now there. This has been unthinkable at one time. Brookings is a progressive institution. You would not expect a Fed chair to be there. But he is no less there. And interesting here, this is on the 23rd. We'll go to this later. We'll start featuring him. Here, can China be like Chattanooga? Shift from industry to services. And we'll just open this up. We're kind of tempted to. This is China, and what will China start to do? Well, they are shifting to a service economy, which would be more of their internal economy. And we previewed this enough, and I'll just... So China's economy certainly has its share of short-term problems, including bad loans. Well, they're clearing those up. A shaky stock market. We talked a little about the shaky stock market. China's biggest economic challenge is to make the transition from a top-down, heavy industrial growth model to a bottom-up service model. The U.S. did that. Could China do worse than to contemplate the experiences of Chattanooga, that's in Tennessee, and Pittsburgh, that is in Pennsylvania, that moved from steel. The city is now, last time we were there, is clear. When we were there in the 70s and 60s, it was a dirty city, and that happened also in the south side of Chicago. So it's less now. In those transitions, it was argued, well, you can't go to a service economy. You'll forever have problems. Well, yes and no. You always have problems when you're dealing with services, because the services are built on the ability of whomever is consuming that service to buy. And we're not talking about retail consumers here. We're talking about businesses to buy the services. And when we opened up here, we started talking about the proliferation of various types of consultancies that specialize in, whether it be the retail market or various other markets. They are online. They are virtual organizations for the most part, patterned after, no doubt, Moody Analytics. We don't hear as much from them now, but we have all kinds of organizations that follow anything from retail traffic on. And at our Cranston Analytics, we used to be called Cranston Econometrics, and now we're Analytics. Anyway, we change with the future. For those in business, make next week a productive one. For the consumer, obviously keep your eyes on the prize throughout the holiday season, and we'll talk to you next week. Good day.